Stop everything. This is not a drill. This is not a simulation. This is not another hype video about a 1% move in the markets. I need you to stop what you're doing, put down your coffee, lock the door, and listen to every single word I'm about to say. Because while the Western world was sleeping, while New York was closed, and while the mainstream media was distracted by political theater in Washington, the impossible just happened. We have just witnessed a financial event so significant, so earth-shattering, and so historically profound that it marks the end of one era and the violent birth of another. Ladies and gentlemen, Asian guy here, known as John A.G. from Currency Archive. For the last 10 years, we have lived in the era of the everything bubble. We have lived in a world where money was free, where debt didn't matter, and where the path to riches was to buy digital lottery tickets called tech stocks. We were told that data is the new oil. We were told that AI is the new God. We were told that tangible physical assets, things you can touch, hold, and weigh, were dead relics of the past. But in the early hours of the Asian trading session on Wednesday, January 7, 2026, that narrative didn't just crack. It shattered into a million pieces. Silver just became the second biggest asset in the world. I want you to let that sentence sink into your bones. I'm not talking about a mining company. I'm not talking about a crypto token. I'm talking about the physical metal itself. The element argentum number 47 on the periodic table. For a brief shining moment that terrified the central bankers in Brussels and the hedge fund managers in Greenwich, Connecticut, the total global market capitalization of silver surged past the market capitalization of NVIDIA. We are talking about a number that is almost impossible for the human brain to comprehend. We are talking about $4.65 trillion. 4.6565 trillion. Think about what NVIDIA represents. It is the poster child of the artificial intelligence revolution. It is the company that powers the future. It is the darling of Wall Street, the stock that every pension fund owns, and the supposed guaranteed winner of the 21st century. It is a company built on intellectual property, on software, on microchips, and on hype. It represents the absolute peak of the paper economy, and yet, a metal that has been suppressed, manipulated, mocked, and forgotten for 50 years just ran it over like a freight train. The pet rock just crushed the AI god. The poor man's gold just dethroned the rich man's tech. This is not just a price movement. This is a changing of the guard. This is the financial equivalent of the Roman Empire falling. It is the market finally admitting that when the debt bubble bursts, you cannot eat software. You cannot build a missile with an algorithm. And you cannot rebuild a power grid with a line of code. You need atoms. You need metal. You need reality. And silver is the ultimate reality. Let's look at the new hierarchy of the world. For decades, the leaderboard of global assets was dominated by tech giants and oil companies. But today, the leaderboard has been rewritten by the laws of physics and scarcity. At the very top of the pyramid, we still have gold, the king of money, the ultimate store of value. It sits alone on the throne. But now, fighting neck and neck for the number 2 spot is silver. And below them, far, far below them, everything else. Apple, Microsoft, Google, Amazon, Saudi Aramco, the entire paper universe of growth and tech is now looking up at the monetary metals. The S&P 500, the index that represents the might of the American economy, is slowly being consumed by the monetary gravity of gold and silver. This flipping of NVIDIA is the signal we have been waiting for. It is the psychological trigger for what we call the Great Rotation. You have to understand how institutional money moves. It operates like a herd of buffalo. For the last 15 years, the herd has been running in one direction, into the Wall Street casino. They sold their commodities to buy stocks. They sold their inflation hedges to buy deflationary tech. They convinced themselves that the dollar was strong, that technology would solve all our economic problems. But trees do not grow to the sky, and bubbles do not expand forever. We are now witnessing the reversal of that flow. The herd has turned. Capital is rotating out of the overvalued, debt-soaked, hype-driven tech sector, and it is flooding into the undervalued, scarce essential resource sector. And here is the physics problem that creates the explosion. The stock market is massive. It is an ocean of liquidity. The silver market is tiny. It is a bathtub. When you try to pour the ocean into the bathtub, you don't just fill it up, you blow the walls out. This flood of money, trillions of dollars fleeing NVIDIA, fleeing Apple, fleeing the treasury market, is trying to squeeze into a market that is physically limited by geology. It is like trying to push the entire water volume of the Hoover Dam through a garden hose in a single second. It creates explosive pressure. It creates vertical price moves that defy technical analysis. And it creates a reality where silver is no longer just a commodity that trades on supply and demand. It becomes a monetary black hole that sucks in all available capital. If you are listening to me right now and you're still holding tech stocks, if your portfolio is full of ETFs and growth funds, this is your final wake-up call. The market is screaming at you. The market is telling you that the era of digital wealth is ending and the era of physical wealth has begun. The smartest money in the world, the sovereign wealth funds of the Middle East, the central banks of Asia, and the ultra-IG net worth family offices, is fleeing the casino. They are dumping the chips, they are selling the pixels, and they are grabbing the cash, but not fiat cash, not dollars that are being printed into oblivion. They're grabbing the real cash. They are grabbing silver. This rotation is driven by fear. It is driven by the realization that NVIDIA, at $4 trillion, is priced for perfection in a world that is falling apart. But silver is the engine of the modern world. You cannot have AI without silver. You cannot have green energy without silver. You cannot have a modern military without silver. So, while NVIDIA is a bet on a software future, silver is a bet on survival. And in 2026, survival is the only trade that matters. But here is the part that should make you tremble with excitement if you are holding physical metal. Here is the part that proves we are not at the end of the rally, but at the very beginning. Despite this historic achievement, despite silver becoming the second most valuable asset class on Earth, alongside gold, the price per ounce is still ridiculously low. You look at your screen today on January 7th, 2026, and you see the price hovering around $80. And I know what some of you are thinking. I see the comments. I hear the fear. You are thinking, wow, $80. That is expensive. I missed the boat. It has gone up too much, too fast. Maybe I should wait for a pullback. You are wrong. You are fundamentally mathematically wrong. You haven't seen anything yet. Because if you actually do the math, if you strip away the money printing, if you strip away the currency debasement, and you look at the real value of that $80, you will realize that we are not at a top. We are at a 50% discount. We are looking at the cheapest asset on the planet hiding in plain sight. We need to look at the inflation-adjusted reality. We need to look at why the catch-up trade to $200 isn't just a speculation or a moonshot. It is a mathematical inevitability. It is simply the asset returning to its fair value after 40 years of suppression. Let's do the math together. You have to look at the history books, not just the trading app on your phone. Because if you only look at the nominal price, if you only look at the number 80, you're falling for the money illusion. You are confusing the price with the value. Most people look at a chart of silver and say, oh my God, it hit $50 in 1980. Now it is $80. We are at all-time highs. It must be a bubble. That is a lie. That is a mathematical deception designed to scare you out of your position. Let's be honest about what a dollar was in 1980 compared to what a dollar is in 2026. In 1980, you could buy a decent house for $60,000. Today, that same house costs $600,000. In 1980, a brand new car cost $5,000. Today, it costs $50,000. The currency has been debased by 90%. So when you say silver hit $50 in 1980, you have to ask yourself, what is $50 of 1980 purchasing power worth today? If you use the government's own official inflation calculator, the CPI, which we all know is manipulated to look lower than reality, the $50 peak in 1980 is equivalent to roughly $170 today. Let me repeat that. Adjusted for the government's own admitted inflation, the real all-time high of silver is $170. So at $80, we are not at a new high. We are trading at less than 50% of the previous high. we are literally trading at a discount. Silver is the only asset on the face of the earth that is currently cheaper than it was 46 years ago. Real estate is up 10 times. Stocks are up 20 times. Bonds are a disaster. But silver is coiled like a spring that has been held down for 2 generations. And that is just using the official CPI numbers. If you use the real inflation numbers, if you use the methodology from Shadow Stats, which tracks inflation the way it was calculated back in 1980, before the government changed the rules to hide the truth, the numbers are even more staggering. If you adjust for real inflation, the 1980 peak of $50 is equivalent to a price of over $400 an ounce today. Think about the upside potential here. We are sitting at $80. The fair value, just to get back to where we were 40 years ago, is anywhere between $100 and $70 and $400. This means that a move to $200 is not a moonshot. It is not a speculative bubble. It is simply a mean reversion. It is the asset snapping back to its historic purchasing power parity. This is why I say the move to $200 is a mathematical inevitability. You cannot suppress the price of an essential commodity below its production cost and its inflation-adjusted value forever. Physics eventually wins. The beach ball that JP Morgan has been holding underwater for 40 years has just slipped out of their hands. The flipping of NVIDIA was the moment the ball broke the surface. Now it has to fly into the air. And the air pocket between $80 and $200 is empty. There is no resistance. There are no bag holders from 20 years ago waiting to sell, because nobody bought at these inflation-adjusted levels. We are in blue sky territory. So when the media tells you that silver is expensive at $80, you laugh at them. You tell them expensive compared to what? Compared to NVIDIA, which trades at 50 times earnings, compared to the S&P 500, which is trading at valuations not seen since 1929, compared to a bond market that guarantees you will lose money after inflation? No. Compared to everything else in the financial universe, silver at $80 is the bargain of the century. It is the last asset that hasn't repriced to reflect the $40 trillion of money printing we have seen since 2008. The great catch-up trade is simply the market waking up to this discrepancy. The algorithms are realizing, wait a minute, gold is at $4,000, copper is at $6. Why is silver lagging? And when the algorithms realize there is a mispricing, they don't buy a little bit. They buy everything. And this leads us to the psychology of the market right now. Because the rotation we are seeing, the flipping of NVIDIA is not just about math. It is about fear. It is about a fundamental shift in what investors consider to be wealth. For the last 15 years, wealth meant digital digits on a screen. It meant owning shares of a company that sells ads or software or AI chips. But what happens when the power goes out? What happens when the geopolitical order fractures? What happens when the blockade in Venezuela or the export ban in China stops the flow of goods? Suddenly those digital pixels don't look so valuable. Suddenly you realize that you can't eat a stock certificate. This is the driving force behind the great rotation. We need to talk about the shift from pixels to atoms. We need to talk about why the biggest pension funds in the world are suddenly terrified of their tech exposure and desperate for hard assets. Let's look at the psychology of the exit. Let's look at why paper is dying and physical is being reborn. You have to realize that what we are watching right now is not just a trade. It is an exodus. We are witnessing the single largest migration of capital in human history, moving from the fantasy world of Wall Street to the real world of physical resources. For the last 15 years, the entire global economy has been treated like a casino. The central banks provided the free chips, the cheap liquidity, the 0% interest rates. The corporations provided the games, the stock buybacks, the SPACs, the AI hype cycles, and the investors sat at the table gambling with their retirement accounts, watching the numbers on their screens go up and feeling like geniuses. But every gambler knows that the chips on the table are not money. They are plastic. They are promises. They only become money when you walk to the cashier window and cash them out. And right now, the biggest whales in the casino, the people who actually understand how the plumbing works, are quietly getting up from the table. They are walking to the cashier window and they are realizing that the casino doesn't have enough cash to pay everyone out. So instead of asking for cash, they're asking for the chandeliers. They're asking for the silverware. They are taking the physical assets of the building because they know the paper promises are worthless. This is the difference between wealth on paper and wealth in hand. Think about your NVIDIA stock or your Apple stock or your S&P 500 ETF. What do you actually own? You own a digital entry in a database maintained by a brokerage which holds a claim on a custodian bank, which holds a claim on the company. It is a chain of counterparties. It relies on the power grid working. It relies on the legal system working. It relies on the SWIFT banking system working. It relies on confidence. If any link in that chain breaks, if we have a cyber attack, a sovereign debt default, or a geopolitical freeze, your wealth vanishes. It turns into pixels that you cannot access. You cannot hold a share of NVIDIA in your hand. You cannot use it to barter for food. You cannot use it to protect your family. Now, contrast that with silver. When you hold a physical ounce of silver, you have zero counterparty risk. It does not rely on a CEO to make good decisions. It does not rely on the Federal Reserve to print money. It does not rely on the internet being online. It is an atomic reality. It has been wealth for 5,000 years, through every empire, every war, and every currency collapse. It is the only insurance policy that pays out exactly when the rest of the world is burning. And this is why the great rotation is happening now. The institutional investors see the writing on the wall. They look at the US national debt, $36 trillion, and climbing by $1 trillion every 100 days. They look at the unfunded liabilities, $200 trillion in Social Security and Medicare. They realize that the only way the government can pay these debts is to print the currency into oblivion. They know that the everything bubble is actually a currency collapse in disguise. Stock prices are going up not because the companies are worth more, but because the dollars are worth less. But at some point, the music stops. At some point, the currency loses credibility faster than the stocks can rise. And when that moment comes, which is what the flipping of NVIDIA signals, holding stocks is suicide. If you're holding tech stocks today, you are effectively shorting your own future. You're betting that the bubble will never burst. You're betting that the printing press will solve structural insolvency. But the smart money is taking the other side of that bet. They are selling the pixels, the overvalued tech stocks, and they are buying the atoms, which is the undervalued commodities. They are trading the promise of future profits for the certainty of present value. This is why silver is overtaking NVIDIA. It is the market voting for truth over hype. It is the market realizing that in a world of lies, the only honest thing is an ounce of metal. And do not think for a second that this is a slow process. In previous cycles, these rotations took years. But in the digital age with algorithmic trading and global interconnectivity, these rotations happen at the speed of light. The exit door is small and the building is on fire. Everyone is trying to squeeze through at once. And when the smart money tries to convert trillions of dollars of paper profits into physical metal, they run into a terrifying problem. They run into the reality that the metal simply isn't there. The casino is empty. The vaults are bare. We are already seeing the signs of this panic in the plumbing of the financial system. You don't have to wait for the crash to see the stress fractures. They are appearing right now in the most critical market of all. We need to talk about the comics. We need to talk about what just happened in the physical delivery warehouses this week. Because if you think the NVIDIA flip was crazy, wait until you see the numbers coming out of the New York vaults. We are talking about a non-Delhi month that just turned into a run on the bank. Let's look at the breakdown. Let's look at why JP Morgan is panicking. The panic is no longer just a feeling or a theory discussed in chat rooms. It is visible in the hard, cold data coming directly from the belly of the beast. If you want to know if the system is breaking, you don't listen to what the bankers say on CNBC. You watch what they do in the dark corners of the futures market. And right now, the data coming out of the comics, the primary exchange for silver futures in New York, is flashing red warnings, that we haven't seen since the depths of the 2008 financial crisis. We need to talk about the January anomaly. For those of you who don't trade futures, let me explain how the calendar works. The COMEX operates on a cycle. There are delivery months like March, May, July, September, and December. These are the months where the big contracts expire and where the major banks and industrial users traditionally settle their accounts. And then there are non-daily months. January is supposed to be a non-daily month. It is supposed to be a ghost town. Historically, nobody stands for delivery in January. The volume is low. The traders are on vacation or rolling their positions to March, and the vaults stay closed. It is supposed to be quiet. But this year, January 2026, it is a war zone. We have just received the official delivery reports for the first 3 days of the month, and the numbers are absolutely staggering. In a month that is supposed to see zero action, we have just seen 4,697 contracts stand for physical delivery. Let me put that number in perspective. Each standard COMEX contract represents 5,000 ounces of silver. So if you take 4,697 and multiply it by 5,000, you get a total of 23.5 million ounces. 23.5 million ounces drained from the available float in just 72 hours in a month, where nothing is supposed to happen. This is not normal. This is not a glitch. This is a run on the bank. This is the equivalent of depositors lining up around the block at 3 in the morning to pull their cash out of the ATM because they heard a rumor the bank is insolvent. The whales, the massive family offices, the sovereign wealth funds, and the industrial giants are breaking protocol. They are not waiting for the official delivery month in March. They are paying extra fees, they are jumping through hoops, and they are demanding their metal right now. Why? Why would a sophisticated investor rush to take delivery in a non-daily month? There's only one reason: lack of trust. They no longer trust the COMEX to hold the metal for them. They no longer trust that the silver will still be there in March. They are looking at the same inventory reports we are. They see the registered stocks, the metal available for delivery, dropping to historic lows. They see the eligible piles, which are not for sale, remaining stagnant. And they are realizing that there are more claims on the metal than there is metal in the vault. So, they are front-running the inevitable default. They are grabbing their chairs before the music stops. And look at who is on the hook for this. Look at who has to deliver this metal. It isn't some small trading firm. The data shows that JP Morgan itself, the custodian of the hoard, the supposed master of the universe, was forced to issue 63 out of 150 delivery notices on Tuesday alone. This is a sign of extreme stress. Usually JP Morgan is the one taking the silver to hoard it. For them to be issuing notices, for them to be coughing up the metal, means they are being squeezed. It means they are out of options. They are being forced to raid their own strategic stockpiles to satisfy the voracious demand of these new whales. This 23 million ounce drain is a massive hole in the dike. And remember, this is just the beginning of January. We have 3 more weeks of this non-daily month left. If the drain continues at this pace, we could see 50 million or 60 million ounces leave the conks before we even get to the main event. And this creates a terrifying setup for the bullion banks. Because if the vault is being emptied in the quiet month, what happens when the loud month arrives? What happens when the massive March contracts come due? The banks have sold paper promises for March, assuming that January would be boring. They assumed they would have time to restock. They assumed they would have time to maneuver. But the whales stole their time. The whales stole their inventory. This is the definition of a short squeeze. It isn't just about price. It is about logistics. It is about the physical inability to move enough bars of silver into New York City to satisfy the contracts that have been written. And when the market realizes that the vault is empty, when the rumor spreads that JP Morgan is scraping the bottom of the barrel, the panic will go exponential. The 4,697 contracts we saw this week will look like a rounding error compared to the tsunami of delivery demands that will hit in March. We are looking at the potential for a catastrophic delivery failure, a default. And if the COMEX defaults, if they are forced to tell a contract holder, "We don't have the silver, here is a check instead," The game is over. The price decouples instantly. Paper goes to zero. Physical goes to infinity. So do not let the quiet days on the chart fool you. Beneath the surface, the plumbing is exploding. The pressure valves are blowing off, and the banks are staring down the barrel of a disaster that is mathematically guaranteed to hit in less than 60 days. We need to talk about the March disaster. We need to map out exactly what is going to happen when this January momentum crashes into the March expiration. Let's look at the timeline of the default. Let's look at why the bullion banks are facing their judgment day. If you think the January numbers are scary, you need to understand the mechanics of what is coming in March. In the commodities world, March is a major month. It is one of the primary delivery windows on the calendar, where the biggest contracts expire and where the industrial giants, the Teslas, the Apples, the Samsungs, traditionally secure their supply for the year. The banks build their entire risk model around the assumption that they will have enough metal in the vault to handle the March requests. They rely on a buffer. They rely on the inventory sitting in the registered stockpiles to act as a shock absorber. But here is the nightmare scenario that is unfolding in real time. The January whales just stole the shock absorber by draining 23.5 million ounces in a month that was supposed to be dead. The whales have effectively stripped the banks of their defenses right before the main attack begins. The buffer is gone. The float is gone. And now the banks are staring at the March open interest, which represents hundreds of millions of ounces of paper claims. And they are realizing that the cupboard is bare. They are flying blind into a hurricane. This is the delivery cascade. It works like a run on a commercial bank. When the first few depositors withdraw their money, the bank is fine. But when the big depositors see the line forming, they panic. They realize that if they don't get their money now, there won't be any left later. So, they join the line, and the line creates more panic, and the panic creates a collapse. This is exactly what is happening between the January and March contracts. The industrial users see that 4,797 contracts stood for delivery this week. They see that JP Morgan is scrambling, and they are saying to themselves, if I wait until March, will JP Morgan still have silver for me? Or will I be left holding a worthless paper slip? So, they are not rolling their positions forward. They are not selling for cash. They are standing for delivery. They are demanding the physical metal because they know it is the only way to guarantee they can keep their factories running. And this puts the bullion banks in a terminal position. They have sold paper that they do not possess. In a normal market, they would just go to the open market, buy the silver, and deliver it. But as we established, the open market is broken. The premiums are 20%. The Chinese are buying everything. The supply is tight. If JP Morgan tries to go into the open market to buy 50 million ounces to cover their March obligations, they will send the price to $200 overnight. They will trigger the very squeeze they have spent 50 years trying to prevent. They are trapped. If they buy, the price explodes. If they don't buy, they default. And let's be clear about what default looks like in the futures market. They won't put a close sign on the door. They won't file for bankruptcy immediately. They will use a euphemism. They will call it force measure. Or they will invoke the cash settlement clause. They will send a letter to the contract holders saying due to unforeseen market conditions, we cannot deliver the physical silver you requested. Instead, here's a check for the cash equivalent at the current spot price. 2.